If you have a child with special needs, you probably spend a lot of time thinking about their future and how they will be cared for after you are gone. You may want to leave money to help with housing, transportation, personal expenses, medical needs, or other costs. Maybe you already have a will, life insurance, and retirement accounts in place. Grandparents or other relatives may also plan to leave your child an inheritance. All of those decisions come from wanting to provide financial support for someone you love. When SSI, Medicaid, or other needs-based government benefits are part of your child's future, though, the way the money is left matters. Today, I want to walk through 7 special needs planning mistakes families should review before leaving an inheritance. Number 1, leaving the inheritance directly to your child. SSI has financial eligibility requirements, including limits on certain resources. Receiving money or other assets directly through an inheritance could affect eligibility depending on your child's circumstances. Your will may currently say your child receives a certain amount of money after your death. On the surface, leaving the money directly to them may seem like the easiest option. For someone who receives or expects to receive needs-based benefits, more planning may be needed. A special needs trust may give your family another way to leave financial support for your child without giving the assets directly to them. Number 2, naming your child directly on a life insurance policy. Parents often spend a lot of time working on their will while overlooking beneficiary forms connected to other assets. Life insurance is a good example. You may have purchased a policy specifically because you want money available to your child after you are gone. Naming your child directly as the beneficiary could result in the insurance proceeds going directly to them instead of through the estate plan you put in place. Reviewing your life insurance beneficiaries should be part of your special needs planning, especially when a policy could provide a significant amount of money. Number 3, forgetting about your retirement accounts. Retirement accounts deserve the name. The 401k, IRA, or other retirement accounts usually has its own beneficiary designations. Updating your will does not automatically change who receives money from these accounts. Take a look at who is currently named and whether the designation still works with the plan you have for your child. Your retirement account, life insurance, will, and special needs trust should all support the same long-term plan. Number 4, forgetting to talk with grandparents and other relatives. Your estate plan is only part of the conversation. Grandparents, aunts, uncles, and other relatives may also want to provide for your child. Their intentions may be good, while a direct inheritance could still affect eligibility for certain needs-based benefits. Having these conversations early gives family members time to review their own wills and beneficiary decisions before money is left directly to your child. A grandparent may think they are simply leaving their grandchild extra financial support. Depending on the inheritance, however, your child could receive money from investments, property, life insurance, or a portion of an estate. Family members should understand how their plans fit with the long-term plan you already have in place. Number 5, assuming your will handles everything. Having a will is an important part of estate planning, but families with a child with special needs often have more decisions to review. Your will does not control every beneficiary designation attached to your financial accounts. It also does not automatically address how receiving an inheritance could affect needs-based benefits. Look at everything your child may receive after you are gone. What assets do you own? Who is currently named as a beneficiary? Do grandparents or other relatives plan to leave money? Who would manage the money for your child? Reviewing all of these areas together helps you understand whether your current estate plan supports the future you want for your child. Number 6, waiting too long to decide who will manage the money. Deciding where the inheritance goes is only part of the planning process. Someone also needs to manage the trust. The person responsible for managing a special needs trust is called the trustee. This person manages the assets, follows the terms of the trust, and makes decisions about how trust funds are used. Parents often think first about another child, a sibling, or a close relative. Family connection matters, but you also want to consider whether the person is prepared for the responsibility. Will they manage the money responsibly? Will they follow the instructions in the trust? Do they understand your child's needs? Are they prepared to take on this responsibility for years? Choosing the trustee deserves careful thought before your family is faced with an emergency. Number 7, creating a plan and never reviewing it again. Your child's needs may change as they get older, and your finances may look very different several years from now. You may purchase another life insurance policy, change jobs, open a new retirement account, receive an inheritance yourself, or build more assets over time. Family circumstances change too. Someone you chose as trustee several years ago may no longer be the person you want managing money for your child. Reviewing your special needs plan periodically gives you an opportunity to update beneficiary choices, trustee decisions, assets, and other parts of the plan as your family changes. So where does a special needs trust fit into your estate planning? A properly structured special needs trust may give families a way to provide financial support for a loved one with special needs while helping protect assets to certain needs-based government benefits.